Good morning, ladies and gentlemen. Welcome to the UK Commercial Property REIT investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. And I'd now like to hand over to Lead Manager Will Fulton. Good morning.
Mark, thank you very much. Good morning, everyone. My name is Will Fulton, Lead Manager of UK Commercial Property REIT. Quite a mouthful. I'm going to abbreviate that to UKCM, which is our FTSE 250 stock market ticker. I'm joined by Jamie Horton, Deputy Manager, and the two of us are going to take you through a 35 minute presentation based upon our results, but I'll try and use it to give an indication of where I think the property market is going at the moment. The slide you're looking at, property, is all about property. It's also about capital allocation, but this is one of our recently completed assets, industrial asset at Bolney, halfway between Brighton and Gatwick. And one of the themes that you'll hear me talk about is that industrial market. UKCM has a quality portfolio, and that's quite a distinctive feature. We've got a quality portfolio of around £1.25 billion. So good scale and very good liquidity in the stock. And of course, a clear distinction between a listed REIT closed-ended fund compared with open-ended funds, which you'll be aware from, I'm sure, from the papers, have a habit at times of gating and restricting shareholders, the unit holders, of getting money. So we're open, we're listed on the FTSE 250, we've got good scale and liquidity. We have a disclaimer slide, which I'll skip through at the moment, but there for information. And then on to just some important points that we talked to the market about a couple of days ago. I'm really pleased to say that for the second year in a row, we've had more than 6% earnings growth. So 2022 over 6%, and last year we generated more than 6.3% earnings growth for shareholders, and that's through rent increasing. And I'll put some colour on that for you later on. We also, when compared to 2022, our dividends paid in 2023 were 5% up. The other side of that is valuations and the market. 2022 was quite a difficult year as interest rates rose, and that had a negative impact on valuation. So I'm really pleased to see that on top of that earnings growth, 2023, we've seen a year of stability. Our portfolio fell a little bit, 0.9%, but that's effectively a sort of neutral rise. We posted a positive NAV return of 3% in the year. So stability there and strong earnings growth from a really good portfolio. And the final point is capital allocation. And when I speak to our board, we're very proud of this. So we've been very disciplined in the way that we allocate our capital. Most recently, Jamie, you'll talk about some sales that we had. We sold a couple of assets very well and used that capital. Having sold them well, we used that capital to repay some of our more expensive debt. The result of that is that we have very low amounts of debt in the company, below 16% loan to value. And most of that, 90%, only costs us 3.2% per annum. So if you think of interest rates out there and whatever, this fixed rate, low exposure to debt at low cost is really good for shareholders at the moment, but also gives us a lot of flexibility for the future. I'll go through a couple of slides on earnings, and I've talked a lot about this, and I won't dwell on these for too long, but it's quite interesting. When Jamie and I were putting forward our presentation, our working title here, our working title for the presentation was Porridge and Whiskey, and I'll come back to that in a minute, but there's a very good reason for that. But on earnings, you can see here the 3.15 pence per share up to 3.35 cents per share. That represents £2.6 million of extra income generated last year, extra rent leading to the rise in earnings and good capital allocation. Detail on our NAV movement here, 79.7 pence per share at the beginning of 2023, moving to 78.7 pence at the end of the year. So a little bit of a tick down, portfolio down by 0.9%, NAV down by 1.3%, but that is fantastically stable compared to the year before, and we think we've got a very good outlook going forward. Lots of numbers up there, but the thing that I would take away looking at this slide on our strong balance sheet is this loan to value, group loan to value of 15.8%, low cost of debt at 3.2%, and good maturity in the debt. So very, very disciplined and controlled balance sheet. A slide on performance. This table that you're looking at has on the top our net asset value in the lighter blue, our share price total return, NAV total return, our share price total return in the navy blue bar, and I've put in a market indicator, the FTSE EPRA NAREIT indicator, which tracks real estate companies in turquoise. Below that, the direct property performance, how we've done in navy blue against a property benchmark provided by MSCI in turquoise. So the board and Jamie and I and the team that we have are focused on what we can control. We can't directly control share price, but what we do is work to get our rents up, to invest in the right areas of the market. We look at our NAV and our balance sheet, and that's good. But I can't help see, I'm very proud that our share price performance has been good this year at over 13%, outperforming EPRA NAREIT. And a lot of that was in the last 6 months of the year. And I think there are two reasons for that. And it's interesting thinking, if you're thinking, should I invest in real estate? The first is the helicopter view, the macro picture, which I'll come on to. That is looking better for real estate. I'll explain that in a minute. The second, I think, is shareholders and investors are looking under the bonnet of the different real estate investment companies there. Open-ended funds, I'd say quite out of favor, and closed-ended funds, interesting. Those that are in the right place, even better. Thanks, Jamie. Technical issue there. So share price performance really good. And then below that, our direct portfolio, the engine room of the NAV, outperforming on all time periods against the MSCI benchmark. So really, really good to see that. Last of a detailed slide. I'm not going to go through this slide, but just remind you, we have an independent external board that we work very closely with. Jamie and I, Michael and David, who aren't in the room today, Peter and Michelle, we're dedicated towards UKCM. So we spend our time solely on UKCM and for its shareholders. But I have the advantage behind me of a huge wealth of experience of colleagues in Aberdeen helping me, development expertise, access, almost full access to the property investment market in the UK, 8 colleagues spending all their time on that. So we've got a wealth of experience that can help us. And we have some developments underway, for instance, where that's a real bonus, an added advantage, I would say. Now, to outlook and earnings potential. So this little triptych slide here is quite interesting. At the beginning, I mentioned porridge and whiskey, and this was our reminder for porridge here. And porridge, I was actually thinking of Goldilocks, and people will be familiar with the story and the use of Goldilocks, perhaps linked to economics. These three pictures, for me, present a sort of perfect Goldilocks moment of transition, a turning point. I see 2024 as a turning point for the real estate market. The first graph that you're looking at on the left is talking about interest rates. And we have this data from Bloomberg. The top line, the lighter blue line, was a prediction of where interest rates would be, or an expectation in summer 2023, July 23, higher rates coming down, but still higher. And as I'm sure listeners will know, the expectation for rates now is that they've peaked. That's represented by the darker blue line at the bottom. So we think they've peaked. We think they'll come down towards the end of the year from 5.25% to 4.25%, and then we think they'll continue to fall in 2025. And that is fantastic for the real estate market, which is why Jamie and I are having more meetings at the moment with people. What it creates is a bigger margin over a risk-free rate. If you go out and buy a bond, you need to get a risk margin over investing in real estate, and that margin, as these rates move, is becoming more interesting. So more people are paying attention to that, and so we think looking at our stock. GDP growth, economic growth is important for property. I think the real estate investment trust, the share market is at or pretty much at a bottom. The direct market, though, heavily influenced by economic growth, and we're predicting in 2025 1.5% economic growth, and that's in line with consensus, which is great for our tenants. What we actually see, though, is our tenants love our property at the moment. We've got really strong occupancy. 96% of our portfolio is occupied, and the slide on the right-hand side, headed supply squeeze, is directed at our industrial exposure. We have 60% of shareholders' money in industrial, and you can see the light blue line, the turquoise line, is showing a little bit on the right-hand side, a little bit of a tick up on the vacancy across the UK, but the bars represent the supply response, what is being built to fill that gap, and there's virtually nothing. So supply squeeze means there isn't enough of that kind of industrial stock that people like to rent, and so rents are going up. And Jamie's going to talk. We've got some instances of rents rising 70% over previous rents, so a really exciting place for us. Getting near, before I speak to Jamie, trying to translate the wider picture into what UKCM, what Jamie and I and the board are doing in our company. So the company is positioned for growth. Our capital allocation, I believe, is absolutely in the right sectors. We're a diversified company, so we're not a one-trick pony. We don't want to put all our bets on one thing, but we've got a heavy exposure, 60% to this industrial market, which is really good. Very disciplined capital management, and we'll bring that to life. I think it's easier to talk about that in a minute. And of course, asset management, generating earnings, the day job that we all love, speaking to our tenants, negotiating new rents with them, filling any empty space that we have. We're working very hard there, and we've delivered strong earnings growth. You'll see on that slide mention of a hotel that we're building in Leeds, due to finish in Q3, and we'll touch on that a little bit later as well. A little bit of signs coming into this, and I'll do this quickly, but the chart here that you're looking at, we've got a very strong research team, and they've got a big success rate in their calls. So we plotted in the background of this slide, the coloured blue section, what we predict as a house, not for UKCM, but for the market. Along the bottom are all the sectors of the market that we predict: student halls, London industrial on the right, to Southeast offices on the right-hand side, student and industrial on the left. And that range of return, it represents the 3-year annualized total return that we think we can get. It's a spread of 9.5% per annum on the left-hand side to negative 3.7 on the right-hand side. Now the midpoint is that dotted red line. It's about 6.4% market view. And we've calculated, we've overlaid that in navy blue with the exposure this company, UKCM, has to each of those sectors. And when I add up all those blue bars, almost 80%, 78% of shareholders' money is in those sectors set to outperform the market. So again, we've worked very hard to position the portfolio in those areas of growth, which is good. Almost at the end of charts before we get to some actual, what are we doing in the company? But this is quite important and really interesting. The top left chart, the top left bar, looks at our sector exposure across real estate. So 60% of our money is in industrial, as I said, 59%. That's been built up. It's not a new thing. We tilted many years ago away from shopping centres. We don't own any of those, and into industrial, and that's done very well for us. But our industrial is split between London, where we have 4 industrial estates, and some boxes in the regions that you would typically see when you drive up motorways, very well located, and really good rental growth coming from those. Retail can be good or bad. Our retail, I would say, is very good. It's focused on retail parks. Those parks you can drive very easily, park for free. They're full of discount retailers, a little bit of food. We have one, for instance, Trafford Retail Park at the Trafford Centre in Manchester. We have one outside Leeds on the M62 at Bristol. Fantastic conurbation there. Huge number of people coming to that, an IKEA store very near it, and one in Leicester. So places where our tenants can make money, can make a profit, rents are set sensibly, and the return on those, the yields are quite strong. Offices, when Jamie and I in real estate, it won't be unnoticed by anyone listening on the call and in the papers, offices is the hardest part of the property market at the moment to actually predict where it's going. And I've got very strong views. I think there are real headwinds for that sector. And I don't think the valuers who provide the portfolio valuation going into NAV for all the companies have fully reflected the problems in that office sector. So we have very little exposure to offices. And in fact, a few weeks ago, we sold our last West End office, which Jamie, you're going to talk about in a second. Our office exposure probably is 10% now, having sold that building. And one of the offices that we own, I'd happily say it's one of the ugliest offices I've ever seen, but from a cash flow basis, it's fantastic. It's just beside Hanger Lane, West London, near an area of London called Park Royal. Park Royal is probably Europe's best industrial distribution logistics location. So we bought this office. It's now got 8 years of income left. It's got an index-linked rent increase in it, and the idea is that at the end of that lease, we will have planning permission to either to squash the building and either have industrial or residential on that site. So our true economic office exposure is probably more like 8.5%, but in quite a tricky area of the market. And then other is an expression of everything that isn't an office, a retail, or an industrial property. And we've been building up a little bit of an exposure, moving away from leisure perhaps, and moving into student accommodation, where we have 2 very successful schemes, and 2 hotels. Almost 50% of our money, thank you, Jamie, is located in the southeast of London. And really interestingly, we have the potential to collect a £21 million per annum rental increase from the portfolio. So think of that £21 million and how that might arrive. In a second, I'm going to show you a slide which we call our rent bridge, which is a build-up and potential to increase rents. But it's always interesting, I think, to actually put some proof in the pudding. You know, it's all the theory is good, but actually we've delivered very, very successfully last year. So in 2023, we said that we would collect 1.8 million pounds of rent reversion. Reversion is where the rental value of a property, think of it, you know, industrial in our word or whatever, but think of a house. What is the rent that you could get today compared with what someone is paying at the moment? It's the difference between the rental value today and what someone is paying, rental reversion. And we've got a mission to convert that up into today's figure. So we thought we'd get 1.8 million pounds per annum of extra rent. We've already signed 1.6 million pounds of rent, and we've got another 640,000 still to go. So we've actually achieved 28% better than we thought we would. So a little bit of proof of the pudding there. Moving on to a slide that we call our rent bridge. And this, you know, under the bonnet, this is really important for this company. And I think it's quite a distinguishing feature together with our balance sheet from others. On the left-hand side, around 68 million pounds of current annual rent that we reported in December. And we have the potential for that to rise to 89 million pounds. And I'm going to make sure I've got the right number there because it's screen now is quite far away. Yeah, thank you very much. 89 million pounds on the right-hand side. That's a theoretical number. It needs all of our property to be fully let at rental value. And of course, we'll do better on some, less than others. There might always be a bit of vacancy. But the direction of travel from this portfolio and company is upwards. And there are two probably most important bars in there on that journey. The first is the NAV bar of £4.8 million on the left-hand side. I mentioned we're building a hotel in Leeds. We're due to open that in Q3 this year, and that's set to deliver a yield on cost of 7.25%, around £4.8 million. So that's quite short-term extra earnings that comes in. The other bit is this reversion I talked about, difference between rent and rental value of £12.5 million, and almost 80% of that we think is available in 3 years, so quite short term, year on year. There's a table below showing that. And also 75% of it is from the industrial sector, where again, it's really, really supply squeezed, a lot of that in London, and a really exciting part of the market. Jamie, do you want to touch a little bit on the sales that we did and what we did with our balance sheet?
Yep, absolutely. So I have a few slides just on activity within the portfolio and sort of bringing, I guess, the strategy to life. And the first slide details 2 strategic disposals that we completed within the last year, demonstrating that disciplined approach to capital allocation that Will mentioned. Both of these assets were specifically identified because they're low yielding, so a low initial income return. But there was also quite limited opportunity to grow that income return and capture the reversion in the short term. So the first one that's pictured on the left-hand side is a distribution warehouse in Wembley let to Amazon, 180,000 square feet, and we sold that in May last year for £74 million. We disposed of that at a low yield of 3.49%. In this instance, the ability to capture the full open market rental value was constrained by the fact that the rent reviews were index linked, and we would have to wait until lease expiry in 2029 to get the full underlying rental value. On the right-hand side is a sale that we announced earlier this week, and it's a West End office building called Craven House. It's really well positioned, just off Carnaby Street, and it's let to a very interesting tenant called Molyneux. They work in the film and TV industry. Again, however, it's low yielding, and the reversion was constrained by the fact that it's quite an unfavourable, from our perspective, rent review clause. Now, we could overcome that. It would require us, though, to secure planning consent and to incur significant capital expenditure and redevelopment. So actually, on balance, we felt that the best use of resources was to sell that asset, and we did so at a yield of 4.6%, £22 million. These are strong sales. They were both completed in line with valuation, and the blended yield on them was 3.8%. When we compare that against the opportunity to repay our revolving credit facility costing 7.2%, it's very clearly earnings enhancing for us. And over the course of the last 12 months, we reduced that draw on the revolving credit facility by 83%. So we're really pleased with that. The next slide just shows the limited vacancy that we have in the portfolio. As Will mentioned, this is really low at 4%. And just to try and put that into a bit of context for you, when we look at our benchmark, it's about half the benchmark level. The majority of the vacancy that we do have is shown at the 4 buildings pictured. On the top left is Ventura Park in Radlett. That's our large multi-let industrial estate north of London on the M25. The biggest asset within the portfolio and a really strong performer. I'll come back to that asset in a minute, but we have a couple of buildings there and good interest in them. On the right-hand side is a building that we developed last year, and this time it's in Leamington Spa. It's a building of 67,000 square feet, albeit you could subdivide it to accommodate smaller requirements. It's been built to a really high specification, great ESG credentials, the sort of thing that we know occupiers want. Bottom left, we have Gatwick Gate in Crawley, another multi-let industrial estate. And we've got 3 buildings vacant there at the moment, but really interesting conversation with parties coming onto that space potentially, and also tenants upsizing. And then on the bottom right is shown the white building in Reading. Just to be clear, it's not that entire building that's vacant. It's a couple of small suites in there. It's 85% occupied. That's a building that tenants genuinely like. It works for them. It's future-proofed from our perspective in that it's got great ESG credentials. For example, it's all electric. It's got good amenity in there, a roof garden. Tenants are really engaged and they like it. So the message here is we've got low vacancy. We've got where there is vacancy, it's in good buildings with strong fundamentals, and we're really confident in letting these up. Now, just in terms of evidencing that point slightly, as we sit here today, we've 20% of our void under offer to let, and we've also completed one really strong letting already in January, and that's a relatively small retail element of a much larger office holding in Edinburgh. I'll come back to that in just a moment. So we have good momentum, and we're confident of securing good tenants, good rents at the vacancy that we do have. The next slide just covers off some of the deals. It's really busy, but we're slightly unapologetic about that because you want a busy asset management slide. It means that the portfolio is active, and this is where we've got that additional rent of 2.6 million over the last year that Will mentioned. I just wanted to pick out 3 examples. And the first is Ventura Park in Radlett again, the industrial estate I mentioned, north of London. We had 2 units here which were occupied by Warner Brothers. They indicated that they would come out of those units at the start of 2023. We were able to let both of them, really without void and with very minimal capex to new tenants, and we increased our rents by 69%. And that really set the tone for very strong leasing momentum last year, which we're continuing to see. On the bottom left,
I have to say, Jamie, that might be where my whiskey came in. I do have to admit that.
Indeed, yeah. Well, that's the theme. These are the whiskey moments where we allow ourselves to celebrate slightly. On the bottom left is Sussex Junction in Bolney. Will mentioned this. It's pictured on the front cover of the presentation. But it was partially pre-let when we funded it, and there was one speculative unit where there was no tenant. But we let this on really strong terms, a long lease, and at a rent that was 12% ahead of where we underwrote the transaction. Yeah. So we got the benefit of taking that development risk. And then the bottom right is the unit that I mentioned that we've let in January in Edinburgh, part of a much larger holding. But you may be able to see that the unit was formerly occupied by the retailer Joules. They entered administration last year and the unit came back to us. We ended up with 3 parties competing for this, so a range of uses, leisure, banking, but actually we've let it to the retailer phase 8, and we've done so ahead of our ERV, our estimated rental value. So a really strong result there. Going to just quickly touch upon our ESG strategy, which is really critically important for us. It's a real focus for our board and within Aberdeen. We, for example, submit to the GRESB benchmarking system. We're rated as 3 stars. We've been awarded a gold rating for the disclosures that we make in our report and account. So it really is an important issue for us and for the wider real estate industry. This slide deals with environmental aspects of ESG, and for us, there are really 2 strands to this. The first is compliance with minimum energy standards. There's forthcoming legislation that estimates that property will have to have an EPC, an energy performance certificate, which is a rating of its efficiency. Just to reconfirm, in terms of energy certificates, we think that we are really well placed against the forthcoming legislation. 86% of portfolio by ERV already at the anticipated minimum levels, and the assets that don't comply, we either have a plan in place for them, or there's a very good reason as to why we won't need one, for example, to developments.
And Jamie, is it fair to say that a lot of the office market could be in trouble with this? So again, why it's really important to look under the bonnet of companies and look at what they own, because this could be a big amount of capital cost for some owners of property, which won't be rewarded by it's a necessity that won't be rewarded with growth. So that's why it's one of the reasons we pay particular attention to it. So,
absolutely, I think the largest areas of concern are definitely older offices and I think large format shopping centres, for example. So we're pleased we don't have exposure in those areas. So just to finish off on the environmental side of things, the two graphs show our aspirations to meet net zero carbon. We have two announced targets. That's to meet net zero in scope 1 and 2 landlord emissions by 2030 and all portfolio emissions by 2040, so showing a level of ambition to be ahead of the UK's 2050 target. We have a relatively short data set. The last full year we have is 2022. The graphs show that we are well under the trend line that we need to be on. And if we look at our baseline year, we've actually reduced portfolio emissions by 25% since that baseline year. So lots of work to do, but we're in a good place. The last slide for ESG and from me, it just covers the social aspects of ESG and how we use the portfolio to meet our social obligations and our ability to positively contribute to society. Nowhere is this more important than in our operational student housing asset in Exeter. This is a 226 room development that we completed in 2022. It's let directly to the students, which is what we mean by operational. But we have an appointed operator called Homes for Students, and they're a market leader in the sector, and they run this on our behalf. Our focus and their focus is on providing a real high quality, safe, high amenity and engaging environment for the students. Homes for Students ran 60 events in the opening year. Now, that ranges from welcome meet and greets, Halloween parties, movie nights, award ceremonies, really looking to foster a sense of community so the students feel engaged and supported. They also encourage them to take up issues that matter to them. So we have, for example, appointed environmental leads, and they'll take the lead on things like recycling and reducing energy consumption. So this focus on a sense of community and the social aspects of ESG is really translated into asset performance. This is the top rated student housing scheme in Exeter, and that's on an independent website, Student Crowd, where the students review accommodation. We've got really high occupancy this year, and when we look forward into next year, we're already 45% booked for the next academic year, and we're forecasting a 6% growth in revenues. So for us, that focus on ESG, a sense of community, is really driving performance at this asset. I'll pass back to Will for his closing thoughts.
Thanks, Jamie. Thank you very much. So I would probably sum up by saying we're maintaining a diversified company, but we have got big exposure to industrial, a lot of money in London industrial, and as everyone can either knows or can guess, there is not a lot of spare land in London. There's a huge amount of demand for good product, and we're seeing jumps like 70% in rent, but still creating value for money space for our occupiers. So that exposure is good, and we're alert to that, and we can, we'll move that if we see fit. But at the moment, we think there's a long run of positivity for that industrial sector. E-commerce is not going to go away. And in fact, only 2 days ago, I was in with one of the big property agencies in the country. They have a separate supply chain business within them. And this is where logisticians, retailers will speak to them and think about where are we going to have our warehouses. They were quieter last year. They're having a lot more meetings this year. So the onshoring, cutting the length of supply chains, thinking about what is going on in the world is leading into growth in industrials. We've had 2 really good years of earnings growth, and that's through strong asset management, boosting rents in the portfolio. Really disciplined and controlled capital allocation. So we've got some great buildings, but we're about cash flows. When it looks right to sell, we'll do that, and then with the proceeds, we'll think what is best shareholders. In this case, it was repaying that more expensive debt. So we've got very, very low levels of debt, very low cost debt. Good for earnings at the moment, but good for flexibility, perhaps to take advantage of future opportunities. And valuation stability, leading into this helicopter view of a better macro environment, more meetings that we're having in the sector. So thank you very much. That concludes our presentation. Mark, over to you.
That's great, Will. Jamie, thank you once again for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the guys take a few moments to review those questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Will, Jamie, you've received a number of questions from investors throughout your presentation. So firstly, thank you to everybody for your engagement this morning. If I may, maybe I can start off with a question that we received ahead of the event, which was regarding your debt, and really, how does this compare to your peers?
Very, very well. I would say that we have the lowest amount of debt in the sector, which is good, and it's good again for two reasons. The debt that we have, a little bit over £200 million, 200 of that £1 million is at 2.9%, so very low cost, goes on for a long time. That's great. It also gives the flexibility that if we see right opportunities at the right use of capital, then it would be interesting to look at rising that and thinking of where rates are going and our expectation that they'll come down. I think it's a great place. So I'd say lowest in the sector.
Very much indeed. Let's turn to the next question around dividends. You know, how well protected, I guess, is the dividend, and what does that really mean for an investor looking for regular income?
Yeah. Okay. So well covered. Our quarter 4 2023. So the last quarter we were 103% covered, but perhaps looking wider for the year 2023, we were 99% covered. So pretty much covered, a bit more than covered. I think looking forwards and thinking of the slide that I called rent bridge and the potential for earnings growth, we've proven we can deliver that. Earnings growth means rental growth and controlled P&L use of debt. We've got a lot of really good stories to come through. We're on an upwards rental and earnings trajectory, and the direction of travel, I'm not going to give any forecasts or anything on dividend, but one of the purposes for more earnings is more dividend, and so that'll be interesting to see how that develops out.
That's great. I might stick down that theme. I mean, you referenced debt. Will you use the dry powder that your debt provides to buy more properties? And really, what would you look to buy? You know, what are the criteria for your investment selection?
Yeah, it's a really good question. So the first question is, and management team and the board looking at how capital is applied. So that's the first question. Different ways of doing that, and we review everything from share buybacks to special dividends to actually allocating money into new investment. But the property market, thinking of that turning point, the Goldilocks moment, the porridge that I talked about earlier. We really do believe that interest rates are going to come down, and I think you can fix debt, 5-year debt at say 4% at the moment, and you could imagine getting a margin of perhaps 1.5%. So new all-in debt could be lots of variations here. It might cost around 5.5%. We're beginning to see quite a lot of interesting opportunities in the market, and we're on a seesaw at the moment, and it's a bit of an intellectual seesaw for me that I think interest rates and that cost of debt will become cheaper as we move through the year. I think there will remain opportunities in the property market that are really interesting for the year, and so I think the next 3 to 9 months, I suppose, are quite an interesting period to get that balance of cheaper debt linked to good opportunities, but not maybe wait too long. Once interest rates are lower, everyone else will be in there. So we want to take advantage of that sooner. As to where those opportunities lie, I'm interested. We've got very, very low exposure to the retail parks that you talked about. Retail parks have repriced quite a bit. We've got a lot of experience with the team on locations of parks. Like everything, not everything works, but where they're busy, where the rents are low enough for our tenants to make a really good profit, then we're really positive on that. It's a retail park is an ugly industrial unit dressed up as a shop. The benefit of that is it has very low depreciation. It's very easy to maintain, cheap, free car parking for people to visit. Retail tenants love them in the right place, Manchester, Leeds, Leicester. So that's one area. Also, I'm interested in parts of the student and the hotel market. I mentioned we're building out a hotel in Leeds. I'm definitely going to upset someone on the call, and I'm not a fan, but Leeds United being promoted would help that, I'm sure, a little bit. But we spend a lot of time researching the market, and anyone who's lives in Leeds, or more importantly, I suppose, who's had reason to visit, there's a lack of decent quality hotel space. So we're aiming for a really good hotel right by the railway station, which we can have room rates of about £100 a room or thereabouts. So quite economical, but new, insulated. You get a really good night's sleep, amenity on the roof. I think that would be a fantastic success. Exeter and Edinburgh are our two city centre student schemes that do really, really well. So I could do a little bit more of that as well. I should say the office market is one which worries me, so I'm not expecting to be going into that direction anytime soon.
Great, thanks very much, Will. I guess maybe just extending on the point that you've got firepower and the fact that open-ended property funds are facing redemptions again. Will there perhaps be an opportunity to get distressed assets from this part?
In a nutshell, yes, potentially. So there are some areas, some of these have closed already. It depends how they deal with it. If an open-ended fund has closed, then they probably have a more gradual time period, and in a way there's less distress. But for those, and there are many successful or have been successful funds that are open, some specialising in long income, where there's perhaps a redemption queue, and there's maybe a little bit more pressure on those. So that's an area of the market that, yes, we're interested in. That long-dated income, which is repriced because of interest rates rising, and maybe pressure to sell, creates some interest. But again, not everything. I mean, we're very, I suppose, discerning in what we want to buy. So, we've got a long-let hotel in Newcastle, Galata Hotel. It's between the city, it's actually right in the city centre. We spend a lot of time, even though there's a long lease there, in actually researching and making sure that that hotel stands on its own feet and it's good demand for it. And the same would apply with other kinds of investment.
That's great. Thanks, Will. The next question I'll read out as it's written. The rental uplifts achieved in Q4 through industrial and office leases were impressive. What strategies are in place to continue capturing rental growth and managing lease expirations effectively?
Yeah, sure. So to get right to it, I mean, this is the focus of the team, particularly Will and I, and David and Michael, the asset managers that were mentioned but can't be here. I'd separate two things, if I may. There's rental growth, which is growth from today, which we would expect to see and be concentrated in the industrial sector. But there's also growth that's already inherent in the assets that we have. And that's the reversion point that Will has touched on, and that's where we have properties that are under rented today. And that's the focus for us and for the team is capturing those. As you can see from the slide that Will has flicked back to, 77% of that reversion is available to us at lease events arising in the next 3 years.
Yeah.
So that's absolutely the focus for the team. We know where those are. We have strategies in place that have identified them, and we know what we need to do now. In some cases, that will involve investing in our assets, and that's a very good use of CapEx that you're investing for growth. And in others, it will be dealing with what we would think of as business as usual. That's rent reviews and lease renewals. So we're absolutely focused on working the current portfolio as hard as we possibly can, working with our tenants, and where we have to, replacing tenants would be sort of an ordinary matter, of course, albeit we have a very, very good track record of retaining key tenants. But yeah, for us, that is a huge element of our strategy.
It is. It's quite interesting. There's one that I remember, one example at Radlett that you mentioned, Jamie, early in the year. One of our tenants is a really successful linoleum provider, and they transitioned. They were in central London, quite a big rent, and they were supplying Canary Wharf with lino for the office kitchens and everything else, and probably many other things. Really clever business. They transitioned. They saw that office market is difficult through COVID, and they moved to supplying lino for schools and universities and hospitals. But they didn't need to be in that central London location, and they wanted to actually make their business more profitable. So they came out to Radlett. We got a market rent, which showed a 70% uplift, which is great. And they're absolutely delighted because they've got a lower cost base, and from Radlett they can serve their market far better. So it's speaking with them, doing it. And I think, Jamie, that ESG point as well, we did sort of the aspirational net zero carbon. Our tenants, particularly the larger ones, take CAD as an example, will have their own ESG aspirations. So it gives us an opportunity to get in and speak to them and to look at lease structures. So yeah, it's great, really exciting. Yep.
Thank you very much indeed, guys. Question here around perhaps CapEx for the next 12 months. Any major capital expenditures planned for 2024? I know you've touched on some of that in the presentation, but anything that springs to mind now?
I think I'd probably say two things. We're finishing off our hotel in Leeds. That will take, I'm going to say, another £25 million.
25 million, yep.
So again, thinking of this capital allocation, one of the reasons of paying down our debt is to then allow us to have a little bit more money without it costing a lot. So that hotel producing a yield on cost of 7.25%, which would be really good. Also potentially some capital growth. We're not probably being fully rewarded on the valuation side because it's a development at the moment. It's not fully built. So really happy to invest in the portfolio.
Sorry, I was just going to also mention that we do receive a finance return on that investment as we move through the development. So while we're drawing on the revolving credit facility to fund it, within the development agreement, we're receiving a finance return of 6%. It really narrows that gap.
Yeah. So there's very little friction. Annoyingly, our accountants aren't able to account for that in our earnings. So that's money still to come. It's not in our, we're not able to put it in our books at the moment. And again, on our industrial, we will look at refurbishments where it's sensible and economic to generate more rent. I think investing in one's own portfolio, one's own ownership is a good thing.
Great, thank you very much indeed. The next question I think is in two parts, but I think you touched on your view on interest rates. But the question reads, how positive are you on the short to medium outlook for the sector, and what are your views on interest rates? As I say, I think you've touched the interest rates.
So as you'd expect, I'm really, really positive on the outlook for UKCM, this company. I think we're in a very good place, but that is driven by those two things. We as a house, we think rates have peaked. Listen to Andrew Bailey and how Bank of England votes, but our expectation is that those rates have peaked, and we're pretty much in line with consensus in thinking they might be down at 4.25% by the end of this year, with a series of rate cuts. Going into 2025, as a house, we probably have a more aggressive view on lower rates towards the end of 2025, but looking at consensus, probably they have them between 3.5% and 4% by the end of that year. So whether we end up being right and they're lower than that or at that, they're going to be a lot less, and I feel very strongly about that than they are now, and that is really, really positive for people looking at allocation between equities, bonds, real estate. We're seeing more interest in the sector. You then get into differentiating between the different routes you have available to invest. And that's where I think UKCM, when you look under the bonnet with its disciplined capital allocation, great portfolio allocation, the earnings growth that we've had and that we think we have to come, then it's a nice story.
That's great.
Should add as well, Mark. It's interesting, and I'm not proud of this, but as potential shareholders, it is interesting to know that we are on a 19% discount on NAV. So not for me for a minute to say that the stock on a NAV looks cheap, but it's quite interesting that discount potential, and our dividend yield is around 5.5%. So I think that's where we are in terms of those parameters. But we're coming into, I think, a turning point through this year and into next positively.
That's great. Well, thank you very much indeed. Well, look, perfect timing as we hit 55 minutes. So thank you to everybody on today's call for your engagement and for your questions. And of course, Jamie, if any further questions come through, we'll make those available to you post today's call. I know investor feedback will be particularly important to you both, and I will shortly redirect those on the call to give you their thoughts and expectations. But before redirecting investors, Will, maybe I could just ask you for a couple of closing comments.
Yeah, absolutely. I mean, first, I'd say thank you very much for listening to us and putting up with our technical glitch on the way through. I hope we've sort of tried to give you a path to looking at the work we've put into UKCM to put it in this position of having low debt at the right time, low cost of debt, very disciplined capital allocation, great allocation. We've moved through the years into the sectors of the market that are delivering rental growth, and rental growth and income is a very important part of property investment. And I think the helicopter macro view linked to the picture of the company, it leads to a really interesting positive year as we go through 2024.
That's great. Will, Jamie, thank you once again for your engagement and presentation this morning. Ladies and gentlemen, please could I ask you not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the fund managers from the UK Commercial Property REIT, we'd like to thank you for attending today's presentation. That now concludes today's session, and good morning to you all.